Klarna's stock market debut is stirring the pot. What does this mean for the future of buy now, pay later? Imagine this. Klarna's much-anticipated IPO launched and immediately soared by nearly 15% on its first day, sending a bold message to the entire financial industry. Many are hailing this as a strong vote of confidence for buy now, pay later, BNPL, companies looking to prove themselves on the public stage. But here's where things get interesting. Klarna managed to raise an impressive $1.37 billion, a clear sign that investors are hungry for companies delivering large-scale embedded financial solutions. The numbers speak for themselves. Klarna priced its IPO at $40 per share, overshooting its initial guidance of $35 to $37. When trading opened on the New York Stock Exchange, shares shot up to about $52, peaked close to $57, and finally settled at $45.82, a robust 15% jump above the opening price. This strong start reflects investor enthusiasm, but there was some pullback as the market recalibrated and digested Klarna's lower public valuation compared to its private high point in 2021. Breaking down the offering, 34.3 million shares changed hands, with around $200 million directly benefiting Klarna as newly issued shares, while the remaining sales profits went to existing shareholders cashing out. It's not just about the money, though. It's also about the message this sends to the market. Who holds the power in BNPL? Fresh research highlights that Klarna controls the largest portion of the US BNPL market, boasting a 26.2% share. Afterpay and Affirm trail at 21.9% and 19.3% respectively. The interesting twist? Younger users, especially those aged 25 to 34, are the most engaged, hinting at a future of sustained and repeated use, potentially building a new generation of loyal BNPL customers. But the story isn't as simple as one company dominating the landscape. Most consumers juggle multiple payment tools. Over 80% of U.S. adults own credit cards, and among those who use pay later products, a significant 38.7% leverage both BNPL and traditional installment loans. So the door remains wide open for Klarna and its rivals to win even more users. Looking at the big picture, opportunities and warning signs. For other financial technology startups watching from the sidelines, Klarna's successful listing is like a big green traffic light, encouraging others to step up to the public markets. After several years where IPOs cooled off, punctuated by the chaos of a valuation drop in 2021 and recent pauses over things like trade tariffs, Klarna is proving there's still appetite for well-run, branded fintech companies ready to scale. But this is the part most people miss. While Klarna's current public valuation, hovering around $15 to $19 billion, a far cry from its eye-watering $45 billion private peak, feels like a step down. The firm's smooth day-one performance could provide not just confidence, but a concrete playbook for other fintechs preparing to go public. And here's the controversy. Some argue that Klarna's more modest price tag compared to its former glory is actually a sign of new investor caution. Yet the strong market response, oversubscription to the offering, and a rapid price jump signals investors are prioritizing companies that can show real growth and diversification, rather than simply chasing sky-high valuations. So where does the market go from here? Can Klarna's experience convince other fintechs to follow? Or will we see caution prevail? Are these new valuation standards a healthy reset for the industry, or do they reflect investor nerves? We want to hear your thoughts. Does Klarna's IPO mark a turning point for embedded finance, or will it prove to be just a temporary spark? Do you agree with the cautious optimism, or do you see bigger risks up ahead? Join the conversation below and share your views. Let's spark a real debate on the future of fintech.